This is a wonderful opportunity to find out a little bit more about the Federal Reserve and how it affects all of us. We are very happy to have Neel Kashkari with us today. Throughout the day, Mr. Kashkari will also be meeting with local business leaders. He's going to stop in and visit Governor Dennis Dugard and Lieutenant Governor Matt Michaels, the legislative leadership. And he's also going to be spending time with some bankers and other tribal leaders. But for the next hour, he is all ours. And I hope you brought your questions because I think it's going to be a great discussion. We've got two roving reporters who will be having microphones. We ask that you please use the microphone so the rest of the room can hear you. And we're just going to get started. Before we do that, I want to just tell you a little bit about Mr. Kashkari. He is the current president of the Federal Reserve Bank in Minneapolis and just celebrated his second anniversary on the job. Among his many duties, Neel also serves on the Federal Open Market Committee, where the Fed makes decisions about interest rates and other monetary policy for the nation. Over the years, Mr. Kashkari has done a variety of things. Among them, he developed technology for NASA space science missions. He worked for Goldman Sachs, he oversaw TARP during the financial crisis, and he's even run for governor of California. One of his goals in his current position is the reason we're here today, and that's to make the Fed more familiar, accessible, and transparent. So please give a warm South Dakota welcome to Neel Kashkari. Okay, we're going to get started, and please remember to use those microphones for your questions. And I'm going to start off with a question that many people might want to ask. Between the recent changes to the federal tax policy and the swings in the stock market over the past few days, there is a lot happening on the financial front. What are you hearing about the long-term effects of the federal tax policy?
Well, first of all, thank you for having me, and thanks all of you for being here today. Before I answer that first question, is it okay if I just take a moment and tell you a little bit about the Federal Reserve? Because a lot of people don't know what is the Federal Reserve. They've heard about it, but they're not sure, and then I'll jump into your specific question right there. So the Federal Reserve is our nation's central bank. Now, if you go back in time, our country has always hated the idea of having a central bank at all, honestly, because it sounds very undemocratic. A bunch of bankers in a dark room doing God knows what. It just doesn't sound very American. Alexander Hamilton created the first central bank in the United States. Then they got rid of it. Then they created a second bank. Then they got rid of it. And then our economy, especially the ag economy, was hammered with banking crises in the late 1800s. And then a really big one, the banking panic of 1907. So Congress at that point said, well, even though we hate it, I guess we need to have a central bank to try to manage these ups and downs. But we still hate the idea, so we're not going to concentrate it all in Washington, D.C. Congress came up with an idea in 1913. They said, we're going to have a distributed central bank where you have the Board of Governors in Washington, D.C. You've probably heard of Alan Greenspan. He was chairman of the board, then Ben Bernanke, then Janet Yellen, and now our new chairman is Jay Powell. They're in Washington, D.C. They're appointed by the President of the United States, confirmed by the Senate. And then you have 12 regional Federal Reserve banks that are not appointed by the President of the United States. I was appointed by a local board of directors, one of whom is here, Christine Hamilton, from South Dakota, and my job is to represent all of you. My job is to represent the 9th Federal Reserve District, which is Minnesota, North and South Dakota, Montana, the Upper Peninsula of Michigan, and northwestern Wisconsin. And this is literally part of the checks and balances that Congress created in 1913 to make sure that this region had a direct voice in monetary policy. So the reason I'm here is to hear from you, to learn what's happening here in the South Dakota economy. So when I go back to Washington, D.C. and we debate monetary policy for the nation, I'm able to speak directly about what you're experiencing here in your community. So that's why I'm here. That's why it's so important that you're here. So thank you for being here. Now, as to your questions about the tax, what it's going to mean for the economy, boy, that's a great question. And that's actually, we were just talking about it in the earlier meeting that I was having, because I've been surprised at how much excitement the tax change has led to amongst our contacts across our district. A lot of people do feel optimistic and enthusiastic about especially about the corporate tax cut. But now the question is it going to lead to more investment? Is it going to lead to more hiring? We're seeing in the press there are some anecdotes of businesses that are paying bonuses to their workers, or in some cases increasing wages. Those are good things, no question. How much is that going to lead to more wage increases? Is it going to lead to more hiring? Is it going to lead to business expansion? The answer is I don't know yet. And so that's what I'm really eager to hear from all of you. What are you seeing in your businesses, in your workplaces. This is very important to us to understand as we think about the future path of the U.S. economy. So I don't mean to defer your question. It's just from my perspective, it's too soon for me to know, but that's a big part of what I'm here to learn about.
Okay. All right. I'm going to ask another question. You've been widely heralded and also criticized for your stance on raising interest rates, or not raising interest rates, excuse me. Can you give us a synopsis of your thinking on why interest rates should remain low?
Sure. So Congress has given the Federal Reserve what we call a dual mandate. And that means, number one, stable prices. So an economy that's not overheating, an economy that's not limping along. And number two, maximum employment. And that means everybody that wants to work is able to find a job. And you can think of these two as related like a seesaw. If the unemployment rate gets really low because the economy is strong, you would expect wages to rise and then inflation to rise. If we're in a recession and unemployment takes off, the economy is probably limping along and prices are maybe falling, and then the seesaw moves the other direction. So we're trying to balance these two out with monetary policy and interest rates. Well, for the past 6 or 7 or 8 years, we've been coming in low in our inflation target. Meanwhile, the job market keeps getting stronger and stronger. And the things we're looking for is, are wages taking off? Is inflation taking off? Is there a reason to raise interest rates and cool the economy down? Well, we've been pleasantly surprised that a lot of people want to work. They're coming back in, they're finding jobs. That's a good thing. And yet inflation is not taking off. And so I'm looking at that and saying, well, why do we need to cool this down? Let's let more people work. Let's see wages actually start to rise. Let's see inflation actually start to come up to our 2% target, and we can raise rates then. So that's why I voted against the interest rate increases last year. But it's a vote. And if you're the only person voting one way and everybody else votes the other way, they went ahead and raised interest rates.
Okay. All right. We had a question that someone emailed in. During the recovery from the Great Recession, congressional Republicans worried about the national debt. Now, with the recovery going nicely, Congress does not seem to worry about the national debt, given the vote for a tax cut that will increase borrowing. Does the Federal Reserve care, and should we care about the debt?
Well, we do care, and we all should care over the long term. Over the long term, there's no question. Countries are like families or like businesses. You need to, at some point, live within your means. And right now, the United States has this premier position in the U.S. economy that we're considered the strongest economy in the world, the most trusted economy in the world. And so investors all around the world are willing to loan the United States money because they say we have faith in the U.S. over the long term. Well, at some point, if we just keep increasing our debt, at some point that's going to be questioned. And investors are going to say, you know what, maybe we'd rather invest in Europe, or maybe we'd rather invest in Asia than invest in the U.S. So at some point we do have to get our fiscal house in order. And that's really going to be driven by our entitlement programs, Social Security, Medicare, and Medicaid. If you look at the forecasts of those, the forecasts are just almost exponential growth in spending on those programs simply because we're aging as a society. If those programs are funded by current workers paying for current retirees. As our society ages and we have fewer workers per retiree, those programs are forecast to go into the red. So we as a country have to make some choices about how we address that. Now, we don't see the deficit and the debt as a near-term issue, but we as a country have to make some tough choices before it really does become an issue and investors decide to go elsewhere.
As a follow-up to that, if we continue with the further debt, do you foresee that we would have serious issues like they had in Greece a while back?
Well, it's unlike Greece. One of the challenges for Greece is they don't have their own currency. So one way, if people start to lose confidence in an economy, you would expect the currency to adjust. And in Greece's case, the currency couldn't adjust because they were part of the euro. And so that just compounded their fiscal challenges. So number one, we have our own currency. So we would expect other adjustment mechanisms to take place. But we shouldn't ignore Greece. I mean, that is an example of a country living beyond its means for decade after decade, and eventually investors saying, you know what, we just don't want to deal with it anymore. So I don't think America will become Greece, but there are limits to how much we can run up our debt before people lose confidence in us.
Okay. How about questions from the audience? Does anyone have anything you'd like to ask? I'll keep going.
Yeah, or,
But,
or what you're seeing in your businesses, in your community. What are the challenges you're seeing? What are the opportunities you're seeing? Could you please introduce yourself too?
Hi, Mr. Kashkari.
Hi.
Kurt Everson, South Dakota Bankers Association. Two questions for you this morning. First of all, you, when Laura introduced you, she announced that you had run for governor of California. Question is, what were you thinking? So you can go there if you wish. But more serious question, we talked a little bit in your meeting with the bankers about the fact that in the post-recession we're in a pretty long economic expansion, and we've basically seen almost zero interest on the part of investors to form new banks in this country. I'm curious if that, obviously the Fed is aware of that, does that concern you, and if so, why? And further, what maybe should we be thinking about to change that paradigm?
Sure. So first, why I ran for governor of California, I care deeply about public policy, and I care a lot about economic policy. My slogan, I like to tell people, it happens to be true, my slogan of my campaign was jobs and education, that's it. My view was if you have a strong economy where people are able to get good jobs and you have a good education system where people have the skills they need, most of the problems in society end up getting addressed by that. Now, so the reason I ran for governor is the same reason I joined the Federal Reserve. I care about economic issues and I want to have a chance to try to make a contribution. I learned the hard way that there's no prize for coming in second in an election. So I'm happy to be here, though. As for the charter question and why banks are not forming, this is a long-term trend that's been going over several decades. There are increasing economies of scale for banks. So one challenge are regulations. We know that the regulatory pendulum swung after the crisis to try to address the risk of bailouts and too big to fail banks, but it's disproportionately affecting small banks, that it's much harder for a small bank to add compliance officers than it is for a $1 trillion bank to add a couple of compliance officers. So we know that. But then you also see the effect of technology. So I do a lot of banking on my smartphone, right? If you were to give me a check, I would take a picture of my check on my smartphone and it'll be deposited that way as opposed to me going to a branch. Those are services that I really enjoy. It's harder and harder for small banks to be able to provide all of the same electronic services that big banks. So there are economies of scale, I think, increasingly in banking. And so I think between both regulations and technology, it is harder for some small banks to try to compete with bigger banks. And so you're seeing a lot of consolidation and mergers amongst small banks and fewer demands for charters for new small banks to form. You also have rural communities that are losing population in many cases. And then the small banks that serve those rural communities, there's just a harder economic model for them to try to be self-sufficient and sustaining. And so I think there's things we can do on the regulatory front to level the playing field, and I think there's a lot of interest in doing that. But I think some of these broader challenges probably are not going away. Thanks. Thanks for your question.
Other questions from the audience?
Hello and welcome to Pierre.
Thank you.
My name is Melinda Darland, and I have several concerns about our economy in Pierre. One reason our young people leave this community is there is no opportunities for them in this Pierre. We have asked for a vocational technical school to try to keep our young people here, educate them, help them to get better jobs. The reason they leave our community is there are better jobs elsewhere. You take Sioux Falls, our other bigger community, Rapid City, we have absolutely nothing to offer our young people. The other thing is, what can we do to keep our young people here? The other thing is, we have tried to get businesses to come into our community so that we have jobs for the people of this community. We can't get them to come in. Our Chamber of Commerce and our City of Pierre fight these businesses tooth and nail when they try to come into Pierre. And it is a fact. And Menard, fortunately, they did still come into Pierre. But these businesses decide after they have to fight to try to come into Pierre and be a part of our community, they say, forget it, we're no longer interested in being a part of your community. The other problem we have is people that try to get jobs for the state of South Dakota, and I know a lady right now that has applied for a job with the state. Every interview she has gone to, she has been turned down. Now the problem here is, and this is from when I was very young, that in order to get a job with the state of South Dakota, you have to know people that work within the state in order to be able to get a job there. If you don't know the right people, you're not going to get a job. The other thing is our Chamber of Commerce president tells us to shop local, buy local, support our local community. We would love to. Fantastic. But then she is out in Sioux Falls, Rapid City, shopping. Okay, you're telling us to do that? Then why aren't you doing the same thing?
Thank you. Oh, go ahead, please.
Okay, ma'am, first of all, thank you for your questions. We do have Jim Protexter with the Economic Development Corporation here with us. I'm Laura Schoen with the Chamber of Commerce, and I'd be happy to visit with you afterwards. And Dave Bonde with the Fort Pierre Economic Development Corporation. And as far as bringing in local businesses, we'd be happy to sit down and visit with you about that. But maybe we can turn a question to something that maybe Neel can answer. What is the incentive for bankers to work with businesses, and how does the Fed play into that?
Sure. Well, and before I jump to that, so the comments that you're offering, I hear similar comments all around our region because small communities are losing their young people, and they're wondering what's going to happen to our small community if all of our young folks go off and don't come back. And so I've seen communities try to address this, some more successfully than others. The communities that have had some success have tried to make their small town inviting so that their young people decide to come back. So they may go off to college and then say, you know what, I enjoyed growing up there, I want to raise my family there, I want to come back there. And so part of it is making the community attractive in terms of amenities and having some restaurants, et cetera. Part of it, you're right, is making sure as many jobs are available so that people are able to find something, a place to work. One thing a challenge that I hear is the access to broadband. Some communities don't have access to broadband, so if somebody wants to set up a small business but they can't get on the internet, that ends up being a big barrier. So broadband is also a factor. So to me, it's the local civic leaders working with the local business leaders to try to address this. But I'm going to be honest with you, it's not easy. I mean, there are big draws to Rapid City. There are big draws to Sioux Falls, big draws to the Twin Cities in Minnesota, and that's probably going to continue to be true. And so there's no easy answer.
But we can look to the city of Fort Pierre, their mayor and Fort Pierre City Council. They are constantly bringing in new businesses, working to make it so that people want to come and invest in their communities. And I think maybe the city of Pierre and Pierre Chamber of Commerce need to take a lesson from our neighbors across the river.
Well, thank you. Appreciate your comments.
I have
Hi.
a question. I work at a bank, and one of the things we hear a lot about is virtual currency and Bitcoin.
Sure.
And I'm just curious your opinions on that, if I'm just a curmudgeonly old banker and therefore think it's overrated, or just what your thoughts are on
Sure.
kind of that emerging payment system.
Sure. So I don't really think this is going to anger people in the Bitcoin world. I don't really think of Bitcoin as a currency. I think of it as a novelty. The idea that these virtual currencies are ever going to compete with the dollar is hard to fathom. And I'll give you an example why. The key selling point when Bitcoin was developed was that you could never have high inflation because by design, they're limiting the number of these Bitcoin that can ever be created. It's just programmed into the design of it. So that should give you confidence, they said. Well, that's true. But the problem is the barrier to entry for anybody creating another version of Bitcoin is zero. So tomorrow I could go create Neel Coin. And you know what? It would look exactly like Bitcoin. Now go back and think, why has gold served the role that it served in the economy over thousands of years? The reason that gold has been this precious thing that people have used as a currency is because you can't just go create more of it. I can't just go in my basement and come up with some new metal that looks exactly like gold, that weighs the same as gold, that has every other property of gold. If I were to do that, I'd be creating more gold. And so that's the key failure of virtual currencies. A month ago, I heard that there were 1,400 virtual currencies that people had created. Maybe there's 2,000 now. I have no idea. And so until somebody comes up with a solution so that these things are actually scarce, it's just a novelty. And it's not a credible competitor to government currency. Now, granted, if you lived in Venezuela or Zimbabwe or some country that does not have a reliable currency and they've got 1,000% inflation, maybe these things could be attractive. But if you live in any modern advanced economy, I would stick with the dollar, I would stick with the euro, I would stick with the yen, and leave Bitcoin for the, the toy collectors.
Mr. Kashkari, Jeff Partridge, Senator
Jeff.
from District 34. Thanks for coming during our session. Appreciate that. In reading the Beige Book, it seems like lately the words of like moderate or modest or slightly seem to be used quite a bit. Do you think that's because of a flat or steady economy or one that's diversified in our district?
Well, I think if you look at in terms of a Federal Reserve District, so let me just look at it from my perspective for a moment, we have a very diverse economy. We have big ag sectors, we've got manufacturing, we've got healthcare, education. Virtually every major sector of the U.S. economy is represented in our region. And that's a good thing because, as you all know, ag might be down, but manufacturing is up and healthcare is up, et cetera. Now, as you get narrower and you look at individual states and different regions in individual states, you end up seeing a lot more concentration. And so I know ag is a big part of the community here. We were just talking about it with some of the bankers and the challenges that the ag sector has had for several years with high land prices and low commodity prices as well. And so I think overall our region really does benefit from the diversity, and the oil sector obviously in North Dakota as well is enormously important. But I know that doesn't provide a lot of answers for a local community that just has a lot of exposure to one or two of those sectors, which, just depending on the economy, may come under pressure. And it may be several years when people have to hunker down and bear with it. Thanks for your question. Thanks for being here as well. Others?
Hi, my name is Ken Brills, and I was listening before, and you said you were against interest rates going up. And with low unemployment and wages increasing across the country, if the interest rate did not increase, how does that prevent inflation from occurring?
Sure. Well, so that's the key question, is when are we going to see you would have expected, the unemployment rate in the peak of the Great Recession was 10%. It's now come down to 4.1%. We would have thought that move would have led to high wage growth around the country, but it hasn't, not yet. And so the question is, when is the job market going to get tight enough that you actually start seeing wages go up nationally? And those are the signs that we're looking for. So some of the early evidence that might be happening is in the labor report that came out last Friday. We saw a little uptick in wage growth nationally. Now, I think that's part of the reason that you saw the stock market react so violently as a result of that, because they thought, oh my gosh, now wages are finally going up. But if you dig beneath the surface, wages went up a little bit, but hours went down. And so it was not actually a resoundingly strong report in terms of the outlook for wages. So we need to see more data. We need to see that wages are going to go up consistently across the board. We need to see that that's actually going to translate into inflation. There's a lot of evidence that even when wages go up, it doesn't actually translate into inflation going up. And so these end up being, the theory is simple. The theory is businesses compete for workers, they bid up wages, they pass those costs onto their customers, that shows up in inflation. That's the theory, but if you actually look at how the economy works in practice, it rarely works that linearly. So we're looking at all the data to try to see, is there still slack in the labor market? Are wages in fact increasing? Is that in fact leading to higher inflation?
But when wages do start to increase, you would think that the interest rates would increase?
So the gentleman asked the question, when wages increase, would I expect to see interest rates increase? I would expect to see, if wages start increasing on a consistent basis around the country, and that is in fact translating into higher prices in inflation, I would expect to see that will affect how the Federal Reserve approaches interest rates, and that could affect the trajectory for interest rates. But we are a long way away from that. We've had one labor market report that was at best mixed, and it is not yet translated into inflation. So to me, I don't want to rush to judgment. I want to look at the data and actually make decisions based on the data. Thanks for your question. Hi.
Question about the change in the tax law and the change in the standard deductions. If you've had any studies or expectations of what that might do to the housing market, rental versus own, and then what's the shrinking of the balance sheet plans?
So I'm curious, before you give up the mic, I don't have a view yet on what it's going to do to the rental versus owner market. Do you have a view?
No, I don't.
No, okay.
I'm curious, between that and the demographics, and if the, they say the millennials are less likely to own, whether that's really true or not,
Yeah.
or that's just as they age in, but just,
Yeah.
and then fluidity between markets because
Right.
of rental.
So, this gets into a broader question of housing. First of all, I've heard all the same stories of millennials that you've heard, but they said the same thing about my generation, right? I think that the older generation always looks at the next generation and says, you're lazy, and I used to walk 20 miles each way to school barefoot, you have cars, and then as people get older and they have families, all of a sudden they need to buy homes too, and they need to save money, et cetera. So I'm a skeptic that the millennial generation is so different from my generation or the generation before me. One thing that you did bring up is housing. And could somebody give me a refill and a glass of water? I'd appreciate it. Everywhere I go around our district, I hear challenges of affordable housing. Everywhere I go. And this is a problem that is not solved by a strong economy. Because if you have a really strong economy and you've got wages going up, what ends up happening is rents go up because people are bidding up the price for the same number of units. So trying to look at this through an economic lens, the question I always ask is, why isn't more supply coming into the market? Why aren't builders saying, well, there are folks here who have jobs, who can afford to pay something, why don't I come in and build more units to make money, providing them more supply? And the best answer that I have when I look around our whole region is that there are lots of barriers to new supply coming in, largely driven by local regulations. Each one is well-intentioned, but when you layer them on top of each other, one after the other, whether it's zoning, et cetera, all of a sudden the minimum cost to build a new home or to build an apartment building ends up being a lot higher than it otherwise would need to be. And that ends up being a barrier to new supply. That ends up driving up affordable housing. So we are looking at this to try to understand what can policymakers do to try to encourage more supply coming in. But it's complicated, and it is we think is largely driven by local and state policies rather than federal government policies as a result of that.
Hello.
Hi, good morning.
Yes, thank you. Speaking of millennials, I'm in that crowd, but glad to have you here. My name's Jason Frericks. I'm part of the state senators that are here this morning, and we're happy to have you here.
Thank you.
I farm and raise cattle. I'm at the northeast part of our state, and I thank you for going to bat for interest rates, because average farmers just like myself, we will spend $20,000 to $50,000, $60,000 a year strictly in interest just to put our crop in the ground. And we have very good federal policy in terms of crop insurance to protect those investments. But it's a huge item on our balance sheet. It hasn't been or cash flow at least,
Yeah.
but it hasn't been a factor so much in the future. But what kind of certainty can you give the active producers? Because you talked about the high land prices, which obviously is one part of the equation. But what certainty can you give us as we go forward? Because we're going to continue to borrow that money in terms of the operating lines of credit. And if the interest rates double, it could really be setting us on the path toward the 80s, which that's kind of the difference we see right now with these low commodity prices. But
Sure.
I welcome your...
Well, I can't give you certainty because we at the Federal Reserve is going to respond to how the economy responds, and we're going to respond to signals of inflation and wages and unemployment to try to figure out the path for interest rates going forward. So I can't make any promises, but if you look at, there are different measures of what we think is going to happen in the economy, and one thing we look at are prices in the bond market So the trading for U.S. government bonds. There's 1-year bonds, 3-year, 5-year, 10-year, 30-year bonds. If you look at the bond market is signaling confidence that inflation is going to be well under control and even low well into the future. Now, nobody has a crystal ball. We don't know for sure how the world is going to evolve, but our current expectation is we're probably going to be in a reasonable interest rate environment well into the future. Now, to the person's question about the deficit earlier, if global investors end up losing confidence for some reason in the U.S. economy and say, hey, the debt in America is just growing and no one is making any tough choices, and imagine that Europe ends up looking much stronger. If all of a sudden investors around the world say, you know what, we're not going to invest in America, we're going to invest in Europe, or we're going to invest in China, you would expect to see interest rates in America go up because now they're investing elsewhere and there's just less money coming into the U.S. That's a scenario where all of a sudden we could be surprised and all of a sudden interest rates are much higher than we think. Now, I don't forecast that happening because I think the U.S. economy is stronger fundamentally, but this then does go back to our political decisions that we have to make as a country. When are we going to get our fiscal house in order? What are we going to do about our entitlement programs? What are we going to do about our tax code to try to make sure that we're living within our means? So I think for the near future, we're fine, but I do think long term we have to make some tough choices. Thank you. Hi.
Hi, I'm Jody Bender with
Jody.
U.S. Bank. The Federal Reserve provides financial services such as electronic transfer of funds, right? How are we protecting the banks and consumers against fraud? Or are you seeing an increase in fraud? I think we've seen that.
Yeah. So there's a couple parts to that question. One is the Federal Reserve itself invests a lot of money and a lot of resources to try to make sure that our own networks are protected because you're right, we are the backbone helping companies transfer money across the wire transfer system, for example, is all being run by the Federal Reserve. So we work very, very hard to make sure that our systems are protected. And then we also try to work with banks, big banks like yours and small banks, to make sure that they have access to the technology and the expertise that they need to protect their own customers as well. So this is an ongoing battle, and I wish that we had a definitive answer to say we've got it licked. I don't think we have it licked. I think it's an arms race that all of us have to stay vigilant and continue to invest in because the stakes are high, and bad actors around the world are always trying to find a way to steal from the U.S. government or steal from your bank or steal from your clients. And so I don't think this problem is going away, and we all just have to keep sharing best practices with each other and to support each other and to stay on the edge of technology.
I'm going to ask a follow-up question there. Our economy, and this kind of goes back to your question earlier, we are challenged by online shopping locally. Do you think there will ever come a point where there is so much fraud and so many bad actors out there trying to get our credit card numbers, our financial information, that it will shift back to more spending locally as opposed to shopping online and doing online business?
I don't want to say it's impossible. I would be surprised because I think that the big online companies are also spending a ton of money to try to prevent fraud and to protect their customers, et cetera. Certainly it's possible, but I would expect that they're in the arms race too, and they're very incentivized to try to minimize fraud, as are the credit card companies, as an example. My guess is it's going to the nature of what we do locally will probably change. Think about locally grown crops that people want for their own food, right? I would much rather buy vegetables and produce that are grown locally, where the conditions that they're grown in, and that I can benefit from that and having that confidence. That's very hard for people to replicate through some online service that I'd be buying from God knows where. So my guess is the nature of what we do locally will probably end up changing, where I'm not going to maybe I'm going to buy toothpaste at the grocery store still. I do today. Maybe I'm not going to end up buying books locally. Maybe the books I'm going to buy online, but the local stuff is going to be food and other things where there really is a benefit to buying locally. I don't know. It's a good question, but change is probably going to continue.
Yeah. Okay.
Hi.
President Kashkari,
Neel.
Neil, I'm sorry.
it's okay.
Neel Kashkari. Reynold Nessebai, I represent, in the state senate representing downtown Sioux Falls. I also teach economics at Augustana University for the last 23 years. So
great.
I'm really honored to be sitting here in the front row and having a conversation with you. So I want an economics lecture. I don't know about everyone else, but so I have a deeper question really about though we don't seem to have a very good understanding. Why aren't wages increasing faster than they are? Why isn't there more inflation? And then to what degree are interest rates a policy variable, and to what degree are they market determined? And if you could do that very quickly, all three of those big questions about what determines wages, inflation, and interest rates, and not take 50 minutes to do it.
I'll do my best.
Thank you.
I'll do my best. Thanks for your question. Thanks for being here. So a big part of economics, it turns out, are our beliefs. That's one of the things that's interesting to me about this whole field of economics, is that it's not simply an equation. It also matters what we all believe about the future. And so expectations, it turns out, really matter a lot. So if you look in Japan, as I'd mentioned earlier, Japan has very low unemployment. I think it's around 2.5% unemployment, but they're not seeing much wage growth, and they're not seeing much inflation. And people wonder why. Well, it turns out, we think, if people are pessimistic about the future, they believe that you're kind of in an economic funk, then it ends up they hunker down, they don't demand higher wages, they save more, and then guess what? You end up in an economic funk. And so people's beliefs about the future are actually really, really important to what the actual outcome is. And that's why if the tax cut does lead to more optimism, which then leads to more investment, that could end up being a net positive for the U.S. economy, because we actually will act on those beliefs. So I think the beliefs are part of it. So when I travel around our region and I ask businesses, are you able to find workers? Most often they say no. And then I say, okay, well, are you raising wages? Most often they say no. And I say, well, if you're not going to raise wages, why do you expect that more workers are going to turn up? And I say, well, why aren't you raising wages? They say, well, I can't raise wages because I can't pass those costs on to my consumers. Well, when I hear them say that, if all businesses say the same thing, I can't raise wages because I can't pass those costs on to their consumers, that's in a sense expectations of a low growth environment bearing itself out. Because if everyone says that at the same time, it ends up being true. And so to me, why are we not seeing that much wage growth? I do think people are used to a low inflation environment. I do think people are cautious because of the Great Recession. And I do think that that's expressing itself in the economy. I'll give you one more example. For me personally, I now personally pay down whatever debt I have as quickly as I possibly can, because I'm scarred from the Great Recession. Now, I didn't lose my house in the Great Recession, but I was scared by the Great Recession, and I know that debt is dangerous. Now, if you multiply my behavior times 300 million Americans, all of a sudden you have an economy that's a little less vibrant than it was before the Great Recession, because everyone is paying down debt as quickly as possible. So part of it also could be psychological scarring from the financial crisis and people just being more cautious. There is economic research that says after the Great Depression, it took a new generation of Americans to come along for people to put the Great Recession behind them, the Great Depression behind them, and get back to more robust economic growth. So you asked very good, very complicated questions, and I took 3 minutes. I couldn't do it in shorter than that. So hopefully that helped. Thank you. Yes. Who's got the mic? Oh, hi.
Hi, my name's Jerry Vogler, and first of all, I'd like to thank the sponsors for bringing the Federal Reserve in. Fantastic to have this opportunity in Pierre, South Dakota. So
thank you. Thanks for being here.
Thanks for you, and thanks to the sponsors. I'm a small business person, and I'm just wondering, going to reflect back on housing.
Yeah.
What's the Federal Reserve seeing as new and novel ideas for housing?
Well, it's, I haven't seen a lot, to be perfectly honest with you. I read an article recently that Seattle has a strong economy, Amazon, a lot of big companies there, that their rents actually went down, the price. And the anecdote that I read, I might get this wrong, was that they had more new construction in the last decade than they had in the last 50 years. So go figure, supply and demand. If a lot more supply comes in, you end up seeing prices come down in response to that. And so I guess the best thing I've seen is just people reducing barriers to people bringing in more supply. I do think it's as simple as supply and demand. You know, one person said to me lately that the way you attract, and this might be controversial, but it's something that piqued my interest, that the way you address affordable housing is not by building more affordable housing units. It's by building more expensive units. And people move into those expensive units, which then frees up, you know, it's like, and it made some sense to me. If low-income folks need to buy a car, oftentimes they're not buying a new car. Maybe they'll buy a car that's 3 or 4 years old, but that's reliable, that's safe, that gets them from point A to point B, but it's a lot more affordable. So that actually, you know, that piqued my interest in saying, well, should we be subsidizing affordable housing units or just stripping away barriers to more supply coming in wherever there's demand? And if you end up adding a lot more supply, even at the high end of a rental market or a housing market, it ends up freeing up supply across the whole market. And so I don't have a great answer for you, but I think a lot of people are looking at this, and we just need to be open to as many innovative models as possible. But I haven't seen an aha moment that said, here's the answer. Do you have thoughts? Usually when people ask me a question like that, they have some thoughts. And so I don't want to miss this opportunity to get your thoughts.
Just my observation is that I would concur with your conclusion that adding more government to the housing picture isn't going to fix housing. Basic supply and demand and letting free enterprise take its course is going to fix housing, and I won't elaborate any more than that. So.
But you know, on this point, some cities and some states have programs to try to subsidize affordable housing. And those programs work, right? There's demand, they build these affordable housing units, but then they can never keep up with the demand. So they build 10 units, and then they've got a line of 1,000 more. And it almost seems like it's, you know, you're putting your finger in a dam type thing. It's just, you're going to get overwhelmed, as opposed to, and creating more supply across the market, which just brings in more supply and helps everybody. So I appreciate your comments. In the back there, I think Alyssa's bringing you the mic.
Hi, I'm Tracy Beck from Beck Motors in
Hi.
Pierre. We're a Chevrolet Cadillac store, and we pay a lot of floor plan interest. And with the interest rates going up, we're paying a lot more. And we're talking earlier about the interest rate and interest rates and inflation correlation. And it seems to me that people talk about inflation as a bad thing. And I don't know that it really is a bad thing. You know, it's kind of a knee-jerk reaction to kill inflation with raising interest rates. But you look at wages going up because of inflation. Doesn't that incentivize people to look at other ways, other maybe technology to keep their wages down, or if say lumber or cars or whatever are starting to get too high because of inflation, maybe people look at alternative means of transportation or alternative building products that might be less expensive, and then it just helps to grow the economy. It just seems to me like the first thought of raising interest rates to kill inflation is a bad thing.
Well, I appreciate your comments, and I think, let me respond a couple ways. One is, I think everyone basically agrees that very high inflation that we saw in the 1970s is a bad thing, because people then lose confidence in the economy, they lose confidence in their investments, they don't know what price they're going to be paying next year. So I think it's generally accepted that we have to avoid 1970s style high inflation. And that's why at the Federal Reserve and most central banks, we have not set a goal of zero inflation. We've set a goal of low but stable inflation, and that's why we picked 2% as our number. And some people debate maybe it should be 1%, some people say maybe it should be 3%. But we really, really, really want to avoid the 10% inflation scenario where people start to lose confidence in an economy. But then your other point is absolutely right. When you start to see wages rise, you are seeing businesses increasingly saying, well, how do I automate this? And how do I turn to more productivity? Productivity at the end of the day is really good for the economy. We do want more productivity. That's how the pie is growing for all of us, more productivity for the same number of workers. And that's why I do think a 2% inflation target, low but positive, has a lot of benefits rather than 0, and certainly rather than 10%. And that's where most central banks around the world have come out. Thanks for your question. Hi.
Hi, Dave Nelson, First Fidelity Bank. With financial markets around the world becoming more integrated, do you feel that's materially affected the way you guys make your decisions? And if so, what kind of effect has it had?
Well, it does. We are a global economy, and the global economy does have feedback loops on the U.S. economy. So when we look at how we think the U.S. economy is going to perform, it's not simply in isolation. We also make forecasts for how we think Europe is going to do, how we think Canada is going to do, Mexico, Asia, and what that means for the U.S. economy. And as we have our own interest rate forecast, we know that that's going to have effects on currencies. We know that's going to have effects on other markets, and then that in turn will have feedback loops back to the U.S. economy. At the end of the day, we are setting U.S. monetary policy, trying to do what's right for the U.S. economy. That's who we work for. We work for the American people. They are our constituents. We're not trying to optimize this for the world, but we do pay attention on what our actions are likely going to have on the rest of the world, because that then has a feedback loop on the U.S. economy. So I think it's complicated, is the short answer, and there are these feedback loops, but we do think the U.S. economy is big enough and strong enough on its own that it's not overwhelmed by what's happening around the world. The U.S. economy is a big enough economy. We consider it, economists will call it a large closed economy in a sense, just because it's so big in itself, it has so much momentum itself, that it doesn't get swung around too much by the rest of the world. As opposed to a smaller country that is even more dependent on trade, it really is like floating in the sea in a sense, where the big waves of the rest of the economy overwhelm what they might be doing there. I don't know, it's a complicated answer to a complicated question. Hi.
State Senator Al Northrup from Aberdeen,
Nice to see you.
and a small business person. Was very interested and intrigued by your comment about the labor report that came out last Friday when you talked about the wages going up but the hours going down.
Yep.
I own a small business that we can adjust our hours, and we're very seriously considering decreasing our hours, say, for example, 10%, and then increasing our wages 10%, and hoping that we can continue to maintain the same revenue. The motivation behind that is having been in business about 22 years, I see a labor market become tighter and tighter, just about impossible lately. So one way we respond to that is reducing our hours and increasing our wages, and hoping that, like I say, the revenue continues. So less of a question, more of a comment. But the other comment I would say is tremendous optimism and looking at expansion possibilities, hiring more, contradicting myself, hiring more people because of the expanded opportunities. So that's kind of where I, as a small businessman, am.
Can you hang on for a second? You say reducing hours. Would you rather maintain the same number of hours and pay more wages, but you just can't? I just want to make sure I understand. Why do you want to reduce hours?
I think that we're in a business that we're in a family entertainment center,
Okay.
which is miniature golf, go-karts, etc. And I think that we can probably maintain our revenue by reducing, instead of opening at noon, we'll open at 1 o'clock in the afternoon. So we think the customers might still come in. So, I mean, those are all strategies that we've got to make a decision on fairly soon as to which path to go, whether we want to. We do know increasing wages is a part of the deal. And then obviously, pricing, what do we do on that?
Yeah, what are you going to do?
So I'm here for a reason, to learn more, so.
Well, I appreciate your comments. I mean, these are the things we're trying to assess for the country as a whole, how businesses like yours are making these decisions. And when you feel confident enough that you can raise prices, I mean, maybe it's not for the round of golf, maybe it's for what you charge for a hot dog. You know, these decisions, multiply your decision making times thousands and tens of thousands of businesses. That's the U.S. economy. And that's what we're just trying to get a sense of. So I appreciate you being here and speaking up. Thank you.
Neel, Brett Aftal with the Division of Banking. You mentioned earlier education being a key piece of your platform in your run for governor. At least in our state, I think nationally the cost of at least post-secondary education has grown much more rapidly than inflation. And recently some reporting, consumer debt, just broadly speaking, has gone up quite a bit lately. What are your thoughts, concerns as you look forward, one on the cost of education, two on the cost or the debt load, consumer debt load, just generally speaking, in our economy, long-term impacts of that?
Yeah, well, I think in this increasingly knowledge-based economy, I think it's well understood that education is just becoming more important and more important and more important, and that's only going to continue. And so all of us, especially it's great that so many state legislators are here, all of us need to be open to finding different ways of delivering education at lower cost. And there are some universities are putting courses online. Not every class can go online, obviously, and not every kid is ready for an online class. But to the extent that there are some classes that are suitable for online, that's a way that shows real promise of reaching more people at lower cost. So I think we need to look at innovative delivery mechanisms and to try to drive costs down. But again, go back to supply and demand. If there's a lot more demand for something, what's going to happen? The price is going to go up. And so we shouldn't be surprised that as there's more demand for higher education, the price is going up. And that's why we need to meet that with more supply to keep the price reasonable. That's number one. And then number two, on consumer debt, I remember before the crisis turning on TV and everyone was celebrating, like economists and market watchers were celebrating the U.S. consumer stepping up, and the savings rate declining and declining and declining. U.S. consumers taking on more debt to drive the economy is not a long-term sustainable model. Right? You cannot just simply lever up either young people going to college or consumers just spending more, and not having any savings to show for it. And so, again, as a country, we have to live within our means. Families have to live within our means. We actually need productivity driving our economy. We need population growth. One thing we haven't talked about here is, as a nation, we're simply having fewer kids than we had in prior decades. And so I always say to audiences, I said it to the bankers before we came in here, we have three choices. We can either accept slower growth, we can do what Japan is trying to do and subsidize fertility. Literally, they're giving tax credits to families who have babies and free childcare, which is expensive, or we can embrace immigration. That's math. But when you think about all of our entitlement programs, you think about our national defense, if we don't have more people working to fund those programs become unsustainable. That's math. And so, the American people have to decide which of those they want. Slow growth, spend a lot of money to try to subsidize fertility, and that's a 20-year investment, or embrace immigration. And so, just trying to get the same number of consumers to take on more and more debt is never going to work. In the back, there's a question? Oh, I'm sorry.
Yeah, I was just saying we have about time for about one or two more questions.
Okay. Hi, Marnie Herman from Security First Bank out in Rapid City. Kind of related to your comments on consumer debt and demographics and all of that, I don't know what the exact percentage is, Jeff probably knows, the number of baby boomers retiring or soon to retire who have zero financial means to support themselves to the end of their life. They have no retirement savings. What's available in entitlement income, if you will, is insufficient in most cases to provide for basic survival. And so then the next generation down is going to be forced to probably subsidize their older parents or their grandparents. And what kind of pressures does that put on overall consumption? So instead of someone in their 50s spending more on vacations or the next this thing or the next that thing, more of our household income, for example, would go to help keep my mother more comfortable or keep my grandmother more comfortable. I have concerns about that, given the number of human beings who are in that older age group who also have insufficient
Right.
resources. And could we comment on that?
Well, I think you're right. We're going to be spending money on different things than maybe we planned. And from a macro economy perspective, if you choose not to take a vacation and instead are supporting your mother, the macro economy is fine, right? That doesn't affect the macro economy. Now, that may affect you and how you would like to be spending your money. And so it's just we as a society have to recognize we're going to be spending money on certain things that we maybe had not planned for. It also means people are going to be working longer. People who maybe had said, well, I'm going to retire at 65, if they're able-bodied, they might not be retiring at 65. And by the way, that's okay, right? I mean, to me, if people choose to work longer, right, one of the big surprises for all of us is how many people have chosen to re-enter the job market, especially older Americans, who people thought, well, no, they've left the job market, they're never coming back. A lot of them have chosen to come back and get jobs. I think that's great. If people are able-bodied and choosing to work again, that's wonderful. There's nothing wrong with that. It keeps them younger and it keeps them vibrant. That's great. And they're saving money or they're providing for themselves. I think that's all positive. So we're all going to have to make adjustments because we are going to take care of each other, and we're going to have to make some sacrifices in doing so. But the sooner we get ahead of it, the better.
Well, thank you very much for being with us today. This has been a great discussion. We need to unfortunately wrap things up so Neel can stay on schedule for the rest of his day. But again, I want to thank you all for being here. I want to thank the Pierre Economic Development Corporation, the Fort Pierre Development Corporation, the Pierre Area Chamber of Commerce, and the South Dakota Bankers Association for working to bring this all together today. Let's give Neel one more round of applause before we
Thank you very much. I really appreciate it.